All right, what is velocity banking? How does it work? How can you implement it? Explain it like I'm a third grader. That's what we're going to be doing in this training. So I have like a voice chat and go back and forth with my best friend all the time. And I've been talking to her about velocity banking and I've been so excited about it for months and months and months now. And it wasn't until I made a video and posted it on my Facebook that she was like, I can finally confess to you that I had no idea what you were talking about every time you talked about velocity banking. So I'm so glad that you made the video. She's like, I still don't feel like I fully understand it, but I'm getting a little bit more of the concept. So that was really helpful feedback for me because it made me realize that, you know, these concepts truly are not mainstream. And particularly for women, but like for a lot of people, we have our own belief systems around money and even words like banking. And so a lot of times it's like a part of our brain just wants to go offline. We are automatically going into it feeling like this is confusing. This is not something I'm going to be able to understand easily. This is going to be complex. And I will be honest, most of the people that I've learned from have, in my opinion, overcomplicated. They've made it, they've used language and used created concepts that I think overcomplicate things and that make it seem like you have to really like understand banking in order to use these strategies. And that's really not true. So let's dive in. What is velocity banking? Well, the word velocity just has to do the by definition is like speeding up, right? Um, so velocity banking means that we want to speed up something related to money. What is it? Well, essentially, there's three things that velocity banking does. Number one, it accelerates your debt payoff exponentially compared to what it would be if you were just making your normal payments without any kind of strategy. Number two, it increases your cash flow. And number three, it accelerates your building of net worth because all three of those things work together. Now, I will confess that when I first learned about velocity banking, many of the examples out there had to do with a lot of personal debt, like a lot of credit card debt or student loan debt or things like that. And I've never really carried a lot of personal debt. And so I didn't really think that it applied to me. However, what I wasn't really considering is that if I could pay off like my car and my house way faster than the normal schedule, right? Than the 5 year auto loan or the 30-year mortgage. And the idea of that actually like totally blew my mind. It expanded me, it liberated me, it made me see the true potential and the true power in this system. And so, even if it's good debt, even if it's like, I used to think like, well, whatever, my business pays for the car. So, who cares if it takes 5 years to pay it off? I'm not trying to like do all these things to pay it off sooner. And it's like, right. But if the car is paid off, then that money that was going to the car payment every month goes to you, right? So every time we're paying off a debt, we're freeing up cash flow. And we can either choose to use that cash flow to pay off even more debts even more quickly. We can use that increased cash flow to increase our savings and our investing and our net worth over here. Or we can, fund our lifestyle too, right? Freedom of choice. So, velocity banking is about speeding up the outcomes with our money. So, speeding up our debt pay down, speeding up our cash flow increases, and speeding up our net wealth or our net worth and our wealth accumulation. So, I'm going to give you a couple examples so you can just kind of see how this could work. So, let me share my screen here. Okay. So here's one example. Um, you can see there's not like tons and tons of different debts. There's a little bit of credit card debt to the tune of around like 4 grand. There's a car loan, there's another car loan, and then there's a home loan. So in total, there's $665,000 worth of debt. The average interest rate is like pretty low, 7.69. The minimum payments on all of this is 10,834. And so this software just helps to compare strategies. So I don't have to like waste a bunch of time showing you all of the math. Okay. So no strategy, which is often just like, let me pay the bill when it's sent to me and I'll pay the amount that's on the bill. That's typically what people do. So the no strategy would take more than 30 years, right? Because there's like a 30-year mortgage plus a bunch of other stuff. And so it won't, this software won't even give us these examples on here because at least one of the debts included would not be paid off in 30 years. Okay. But if we did either a debt snowball, a debt avalanche, or a cash flow index, so debt snowball is you pay off all the debts from smallest balance to largest balance. Debt avalanche is that you pay off all the debts from highest to lowest interest rate. Cash flow index, you pay off all debts with the lowest balance to payment ratio first. Kind of regardless, as long as there's a plan, this goes from taking more than 30 years to pay off and it goes down to 79 months. So 79 divided by 12. So that's like 6.5 years, which is just crazy. That if all we do is go from no plan to a plan, we go from paying off debt in over 30 years to paying off all debts in 6.5 years. That is wild to me. That is like mind blowing to me. And it doesn't even have the interest recapture on here because of this whole more than 30 years thing. But if you remember, the loan on here was 535. If we looked at a $535,000 home loan for 30 years at 6% interest rate, you would pay $619,734 in interest over the 30 years. So generally speaking, whatever the loan amount is that you have on a house, you pay for the house twice. It doesn't really matter what your interest rate is. So you might be like, I brag that I have a 3% interest rate. Well, okay, you definitely pay a lot less, but you still pay 277K in interest. If it's 5%, you pay 500,000 in interest. So just depending on what your interest rate is, a good rule of thumb is that whatever your loan amount is, you're typically going to pay that about twice. You'll once for the house and once for all the interest. So in this scenario, we pay 197,000 total in interest versus over 500,000. So it's an insane amount of interest recapture, like $300,000 worth of interest recapture, right? So that's just money that goes back into our account that then can be used to create more wealth using some of the strategies that I'll talk about in other trainings. So this is the idea of velocity banking. Now, let me just give a different example here. So here's someone who has almost $1 million in debt. And you can see there's like quite a mix here. There's a personal credit card, a business credit card, a personal loan. Hold on. It kind of commingled what we had in the last. Clear all debts. Now load the sample data. Okay, there we go. That's better. $273,000 in debt. So a personal loan, a business loan, or personal card, a personal loan, some medical debt, a car loan, a student loan, a HELOC, a mortgage payment, and then a couple other credit cards. And you can see here that it automatically got sorted by interest rate, high to low. And if we scroll down here, you can see if there was no strategy in place, take 289 months. So about 24 years to pay all of this off. And then we cut that down to 12 years. So we basically cut it in half using velocity banking. And you can see again, like the three different strategies aren't wildly different outcomes, but it's wildly different than having no strategy. So velocity banking is really all about like playing the game of money strategically. And so you can see in this scenario, the debt avalanche, so paying off the highest interest rate to lowest, is the one that is recommended. Um, you save almost $37,000 in interest. And again, you're shaving like 12 years off of all of this debt repayment. And so if you can imagine living in your home is purchased free and clear, you're going to have a lot more cash flow, right? And all of these examples are sort of assuming that nothing changes with your income during this time. So let's say you had even just an extra $100 every month to apply. Well, now you just took an extra 10 months off of any of these strategies, right? And maybe you get a bonus or a tax return one time of $1,000 and you can add that to it. So you can play, you can play around with the numbers, but the concept stays the same. Velocity banking is just all about having a strategy so that your money is working more quickly for you. All right. So that is velocity banking explained. Now, if you're like me, I'm like, I want to see it with my own numbers. I don't want to see it with someone else's numbers. So if you want to see what this would look like with all of your income, your debt, your interest rates, all of the things, reach out to me and we can set up a call and do that for you so you can see it all laid out. We can actually get even more creative than what I showed in this training, because often if there's space on one credit card or depending on your credit and some of the things that you have available, depending on your cash flow, there are ways to even speed this whole system up even further. So typically you can cut like the debt payment time about in half just having a strategy. And then you can usually cut it in half again by adding sort of the next level advanced piece to the strategy based on your income, your cash flow, your available debt tools, credit cards, personal lines of credit, home equity lines of credit, etc. So it truly is so personalized and so customized. So if you want to see it with your numbers, reach out to me and we can talk about how to make that happen.